Hey, John. What are you looking at?
Well, I just invested some money in a mutual fund, and they sent me this book, but I just can't figure out what it is.
Let me take a look at it. Oh, yeah, this is a prospectus.
Oh, a prospectus? Mm-hmm. What's that?
Well, anytime you put your money into an investment that could potentially lose money, they have to send this to you.
Well, what am I supposed to do with it?
Well, the company who sent it to you, they want you to read it so you clearly understand what you're getting into.
Are you kidding me? This thing's over 400 pages long. There's no way I could read this and understand a single thing they're talking about. That's just ridiculous.
I know, but they're required to send it to you. And if you were to read it, you'd see all the details about the companies that are in the mutual fund, the type of risk that's involved, and also all the fees they're going to charge you every year.
Couldn't they just do that in a few pages so an average person could understand it?
Yeah, I guess they sure could, but that's why they have lawyers, to make things complicated.
Well, I'm not going to read this. But I'll tell you what I will do with it. I'm going to use this as a doorstop, prop the kitchen door open so I can see what Mary's cooking up for dinner.
That's not a bad idea. Or you know what? You could use a few pages a day to start your wood stove in the wintertime.
Hey, that's a great idea. This thing will probably last me 3 or 4 years.
At least. It certainly does appear to be a ridiculous request by the SEC, which is the Security and Exchange Commission, and each investment product to expect the average investor to read a 300 to 400 page prospectus from cover to cover. But anytime you invest in a stock, bond, mutual fund, or variable annuity, or most any other type of investment today, you're going to receive one. And if you do happen to read it, it will probably confuse you so much that you really won't have any idea what you just invested your money into. So what do you do with this big book? Most people just end up throwing it away after a short time of storing it somewhere. And the really sad news here is the SEC and all investment companies could greatly simplify the content and number of pages in each prospectus, but they have no motivation to do so at the present time. However, there are 5 important things you should know about any investment product before you put your hard-earned money into. And that's commissions paid, fees charged, 12B1 expenses, turnover ratio costs, and annual taxes you may owe every year. And also, don't let past performance of any product fool you into believing that the future will do as well as the past. Know what you're paying in total fees, expenses, and taxes with each of your investments, whether we're in a bull market or a bear market. So here are the 5 things to uncover and be aware of before putting your hard-earned money into any investment. Number 1, know the commissions you're paying. With most mutual funds, bond funds, and many other investments available today, there is some kind of commission you're paying, either when you buy that investment or sell it in the future. And this commission comes directly out of your deposit or account. This amount could be as low as 0.5% to as high as 8%. So be sure to look before you jump. Number 2, be aware of fees charged. Again, almost all mutual funds, bond funds, and brokerage accounts charge you an annual or quarterly fee to manage and oversee the investment fund you put your money into. Those annual fees can range anywhere from 0.25% to as high as 5% per year. And by the way, this charge does not appear on your account statement each month. It's deducted from your account before your statement is sent to you. So be sure to ask your financial advisor for a published document that shows the percentage of fees that will be deducted from your account before you invest your money. Number 3, know about any 12B1 expense charges. You may not even be aware of this, but mutual fund and bond fund companies can charge you a fee every year so they can advertise their fund to the general public. Can you believe it? As crazy as this sounds, is true. The SEC allowed mutual fund companies in the 1980s the right to charge their customers an annual fee to help a then struggling mutual fund industry. However, with over 10,000 mutual fund companies available today and over $11 trillion in mutual funds and bond funds, I don't think they're struggling anymore. How about you? But they're still allowed by law to charge you a fee every year to advertise their fund on TV, the radio, billboards, magazines, golf tournaments, or anywhere else they care to advertise. The 12B1 expense can be as low as 0% to as high as 1% per year. So the point here is ask about this 12B1 expense before you put your money into any investment. Number 4 are turnover ratio costs. Most fund managers today no longer believe in the old buy and hold strategy. They've almost become like day traders, buying and then selling the stocks or bonds in their mutual fund or bond fund over and over again throughout the year. I've even seen some funds that have a 300% turnover ratio per year. The problem for you, the investor, is that every time the fund manager sells and then buys any assets in your fund, you incur a cost. Here again, you will never see this total cost on your monthly or annual statement because it's deducted from your account before they mail it to you. Turnover ratio costs can average between 0.1% to as high as 3%. So ask about this cost before you invest. And number 5, be aware of any annual taxes you may owe. And this is a tricky one, because the long-term or short-term capital gains tax you may owe every year is dependent on if your fund went up or down the year before, and if your fund manager sold any of the stocks or bonds in your fund at a gain. If so, then you will receive a 1099 statement from them and you'll have to pay tax on the gain, even if you didn't personally want to sell any part of your mutual fund or bond fund. It's a cruel and heartless way to do business, but it's a reality. So ask your financial advisor for a 5 or 10-year track record of the fund's turnover ratio so you will know what kind of aggressive buying and selling of your fund is going on to determine if you might incur an unexpected 1099 bill in the future. As a quick recap, a prospectus is pretty much worthless for the average investor because almost no one ever reads it. However, you can become an informed 21st century investor by discovering what these 5 important potential costs to your account will be before you put your hard-earned money into any available investment today. And to help you understand all of this, download our free report, The Truth About Investment Fees, Loads, and Charges, from the download section of our website. And finally, tune in to our weekly show, Checks and Balances TV, every Wednesday at 4 p.m. Eastern Standard Time, for the balanced truth you need to financially succeed. I'm Matthew J. Rettick, the host of Checks and Balances TV. Thanks for watching this special edition of CBTV. And remember, you can become financially independent. You just need confidence and determination. Until next week, dump debt, invest wisely, believe in yourself, and make it happen.